Okay, so all right, let me just. Good afternoon, everybody. Welcome to today's issuers preview featuring Lapasar. My name is Shah, and I'll be your host for today. Now, first of all, I would like to thank everyone for taking the time to join us in this session. Before we begin, I would like to do a short intro about us. For those who might be new here, pitchIN is an equity crowdfunding platform, one of 10 licensed platforms currently operating under the supervision of the Securities Commission Malaysia. Now, we were licensed back in 2015, and shortly after that, we ran our first successful campaign in 2016. Now, since then, we have done more than 70 companies to date, and we have raised upwards of 100 million ringgit. Right? So on that note, I'm happy to say that we are currently the leading ECF platform in Malaysia. Now, a little bit of housekeeping before I pass on the session to Dinesh. I would like to remind everyone that you are welcome to type in your questions during the presentation. Those questions will be addressed after the presentation during the Q&A session. Now, a little bit about Lapasar. Lapasar is a B2B marketplace selling office supplies to corporate clients and FMCG goods to retailers. Now, they started operation in January 2018 with a goal to democratize corporate purchasing. They are pre-live now with a target to raise minimum of 2 million and a maximum of 10 million for a total of 10.76% equity offered. Now, joining us today, we have Dinesh, the CEO and founder of Lapasar, here to present their offer. Okay, so Dinesh, as and when you're ready.
Thank you very much, Shah, for the kind introduction. Hi, everybody. Good afternoon. Thank you for joining us today. I'll be running you through our pitch and our offer today. My name is Dinesh. I'm the founder and CEO of Lapasar. Just a little bit about me before I get right into the company, and I'm going to keep the pitch really short. And so I started my first company in 2012. I was 22 years old. I was still in uni. And I came across this opportunity to start a medical device trading company. I ran that company from 2012 right up to 2017, where I sold it to a larger competitor. And Lapasar is very much a result of that journey, my experience running that business, partly because as I was trying to sell to more clinics, hospitals, and also corporate clients, I found that corporate purchasing or business purchasing in total was less efficient, less transparent, less quick. Everything about it was not nearly as good as how consumers like you and I purchased on online websites like Lazada and Shopee today, right? And so the idea for Lapasar was to become a B2B marketplace, connecting buyers and sellers within the business environment. So very similar to what Amazon for business does in the US, very similar to what Alibaba does as a B2B marketplace. So we started the business in 2018, January. And as Shah said, we started off in office supplies category. The reason we started with this category is because it's low barrier of entry for us as a company. We needed to gain trust. We needed to gain traction before we moved into any sort of other categories, right? And when we started with office supplies, we listed anything in office buys. So not only stationery, but groceries, furniture, IT equipment, electrical equipment, anything in office needs and wants, right? And we onboarded Telecom Malaysia, who was our first ever client. They were the first one to give us an opportunity to pilot the platform. And after Telecom came on board and it became a success, we onboarded more and more corporates, Tenaga, PwC, Petronas being the latest. And so how we do it for them is we make corporate purchasing extremely fast as opposed to the usual processes, which takes up to 2 to 3 days. We make it within 2 to 3 minutes. And so this part of the business, this category, has become profitable for us earlier this year. And we needed to make a decision, how do we want to make use of these profits to expand the company? And we decided to go into a new category. So it was a category expansion for us. In June 2020, we started our FMCG category. Why we chose FMCG is because it is a large market. It's precisely 5 times larger than our office supplies market. And it's extremely traditional and fragmented, which means a digital solution has has a place or a space to play in to make the industry leaner, faster, and more efficient. And there was a lot of opportunities to digitize. So we chose FMCG and we went into this, where we are connecting retailers directly to distributors and brands. So this is just a snapshot of our traction. Since we started in January 2018, we started with about 40,000 ringgit of transactions. As of last month, we were at 7.4 million ringgit monthly. We were profitable in April to June before we started investing in the growth of the FMCG category itself, and we grew quite massively. And in November, we again hit the break-even point. So this means we will only push for growth harder. So this is just to indicate the wholesale or the FMCG revenue on its own in blue. So just to elaborate on the FMCG business itself further, where we are connecting top-tier distributors of the brands directly to retailers. Out of the total sales that you saw just now, out of the total sales that you saw just now, the FMCG contribution is basically this much. We started with about 30,000 in June, and in July and August we did about 300,000+ each month, and then we started doubling up, right? So we went from 300 to 700, we went to 1 million, and November we ended the month with about 1.4 million. In December we are targeting to hit about 2 million ringgit of sales. So it is growing very, very fast, and it's projected, this category is projected to exceed office supplies in the next 4 to 5 months. There are some similar large companies in the region that are doing exactly what we are doing here. For instance, Gudang Ada in Indonesia got funded 25 million US by Sequoia. Tilio out of Vietnam also got funded $25 million also from Sequoia. So this is an exciting space ultimately. So just to give you a little bit more details on the market, why are we going after the retailer market? The mom and pop shops, right? These are general stores that you see by the roadsides. And we looked into the market as a whole, and we took away modern trade and chain stores, right? So people like Tesco, 7-Eleven, 99 Speed Mart, Family Mart, we took all of those guys out because we cannot serve them. And we only looked into the independent mom and pop stores, the small ones all across the country. There are about 60,000 of those stores. And in total, their revenue output a year is about 60 billion ringgit. So huge market. But when we look deeper into it, we found that this particular market has been totally underserved and overlooked. So the kind of stores that we are going for are the 1-door, 2-door and 3-door stores that you see on the screen. And our team have visited over 7,000 shops since June 2020. We've got 17 salespeople on the ground visiting and collecting data and information. And we can sum up their 3 pain points into 3 main points. The first one is painful and slow ordering process. Today, they only have 2 choices. They can either order from distributors. So what you see on the chain here, right? It starts with the principal, and then they're the top distributors, or wholesalers, and then wholesalers sell to retailers, right? So their 2 choices is they can either order from the distributor directly, or they can drive out to their nearest wholesaler. And typically the wholesalers they drive out to would be people like Mydin, people like NSK, people like Tesco. These are the guys that they would drive out and buy from. When they order from distributors, because the distributors are so large, their priority is never the shops, right? The priority of the distributors are always what we call modern trade clients, or chain stores or large hypermarkets. So whether it is stock allocation, service priority, everything is focused towards modern trade and not these guys. So they go through a very bad experience whenever they order from these distributors. On the hindsight, when they want to go to, say, wholesalers, it's a long, tedious process. So they would have to drive out. If they're buying in bulk from the warehouses of these wholesalers, it's an even longer process. They would have to go through up to 30 steps, pre, during, and post buying from a wholesaler. So the entire experience is quite flawed. Service is not there. And on top of that, they've got severe stock allocation issues because nobody allocates stock for them. The distributors and the brands are allocating stock more and more for modern trade and not these guys, right? and they are financially underserved. Why so? Although a lot of them are banked, they do have bank accounts. They do not use the bank accounts because they are receiving payment in cash, and they're also paying the suppliers in cash. So there's no digital data on them, and banks or financial institutions are unable to serve these guys financially. So what we are doing is we have released our first version of our mobile app was released in September, and a second version will be released as soon as next week. And we are giving them this digital ordering platform where they can either click a button or just send us a message through WhatsApp Business, and the order is captured immediately. And we are only allocating inventory from the brands or the distributors for them, which means this is service that they have never experienced before. And we are delivering to their shops within 48 hours. And on top of that, we are collecting various data points, transactional and physical data points on the shops to eventually launch a financial service for them. So just to give you a few screenshots of the app, when you compare this ordering experience, although it's an e-commerce platform, right, nothing special about it. When you look at it from the retailer's point, you would find that their experience has been elevated multiple folds. As opposed to ordering from distributors, ordering from wholesalers, it's just a click or a message away and their order is captured. On top of that, we are building in a Lapasar wallet to be attached with that ordering app. This is specifically to give them lines of credits. And how we do this is we cannot give them lines of credits or financial services unless we collect data points on them. So how do we collect data points? Today, what we do is we do not offer terms to these guys. When we started off, it was just too high risk. So what we started doing is we insisted on cash on delivery, which I've indicated here, or cash before delivery. Now, by doing that, by enforcing that, why they still order from us is because of the service and the stock allocation, right? And by enforcing cash on delivery, we know exactly what they are going to spend on a daily, weekly, monthly, and yearly basis. So the lines of credits that we are able to give them is extremely accurate. That's one, right? Besides that, we also know physical data points. For instance, do they sell bread? Do they sell cigarettes? Because these are products that are cash. They can only sell these products if they are willing to pay on cash. And that's a good indication on whether or not these shops are healthy financially. Besides that, we also know area retail outlook. We know we have their documents, we have their bank statements that we are aggressively collecting as well. So using all of this data, we were already able to secure our first financial institution partner, namely Aspirasi, which is an Axiata digital subsidiary, where they have approved, in the last 5 to 6 months, we have acquired 1,300 customers. Out of that, they have approved the first 300 shops to receive financing. So this is something new for this market as well, right? Where we are deploying lines of credits to them as well, now on top of the service that we are giving them. So that's the work we do from the tech angle. So in terms of the brands we carry today, we use the hook brands like Coca-Cola, Nestle, and FNN. These are the top brands that every retailer sells. So we are bringing in these brands and we are hooking in more and more retailers, and we are building defensibility on the second tier brands. What I mean by defensibility is this, where we increase our margins and we are getting more and more e-distributorships from these guys. And that's the target within the next 24 months, to basically get official e-distributorships from all these guys, which increases our defensibility in the market. So what we're doing is we are raising a 10 million ringgit investment at a 50 million ringgit pre-money value. So that's basically 16.67% of the company. And based on our current annualized run rate is 80 million. To achieve that, we have only raised 2 million ringgit in the last round, and we still have half the money left. So by raising 10 million ringgit, we are able to then achieve a 500 million ringgit annualized run rate within the next 24 months. With a gross profit of about 6 to 8%, with 10,000 active retailers sourcing on the platform. So out of that money raised, 5 million is definitely used for market acquisition. So getting to that 10,000 active retailers and digitizing them. 3 million ringgit will be spent on building a logistics and operational network throughout the country. We do want to go nationwide. We're currently only in KL and Selangor, and 2 million ringgit will be spent on technology. So this is just to show you how we will be growing from our current 7 to 8 million ringgit a month to 40 million ringgit a month within 24 months. And if you look at our existing trajectory, you can also see the same trend, right? So we're projecting the same thing, partly because our unit of economics is already quite predictable in that sense. So pumping in 10 million ringgit, we are quite confident we will get above the 40 million ringgit a month mark. So within 24 months, we would have 10,000 active retailers, which is basically 17% of the market in terms of number of stores. And what this allows us to do is the ability to scale revenue is very, very high. So all I need to do is add more and more SKUs onto the platform, and revenue scales easily. We already see this happening. We started off with very little SKUs. And as we add 2 or 3 SKUs, revenue is also scaling month over month, right? And along with this, ability to increase margins are also scaling. So the more volume we build, the more shops we have in our ecosystem, the more people want to work with us, meaning brands and distributors, and the ability to earn margins are also increasing. And we would have digitized financial data on about 10,000 shops, which puts us in pole position to be the largest financing company in this space. And with this, we are also building an ecosystem or an infrastructure, not only the technology, but with logistics, warehousing, and financial services. So this is just to show you our funding timeline and milestones. In 2017, Q3, we raised our accelerator round from Nexia, which is a 50,000 ringgit round at a valuation of 625,000. We didn't have any sales that time. In Q1 2018, we raised 400,000 ringgit at a 3 million plus valuation. At this point, we were at about 60,000 ringgit a month or 720K a year. Last June, 2019 June, we raised 2 million ringgit at a valuation of 16 million ringgit from a VC in Singapore called Seed Plus. And the sales that we are at now is 7 million ringgit a month and 84 million ringgit a year run rate. And in December 2020, which is this month, we are hoping to close the 10 million ringgit round at a valuation of 60 million post money. So pre-money would be 50. And we are targeting to hit 40 million ringgit a month or 480 million a year within the next 24 months. And within this journey, there have been 2 early investors that have gotten partial exits as well. So people who have invested 50,000 ringgit have walked away with about 200,000 ringgit already, and still have some equity left in the company. So there have been exit happening in the company as well. So the offer on pitchIN is basically a minimum of 2 million and a maximum of 10 million. Sorry, I made some mistakes here, but the minimum investment amount is 5,000 ringgit, which gives you about 0.09%. And just to show you how that progresses and how our early investors sort of progressed with us and got their exit, this is what we see in the next 5 years. So you're coming in at this point with, say, a minimum funding amount of 5K, and you get 0.009% of the company and estimated valuation of 60 million post money. And we are foreseeing that we will raise 2 more rounds of capital, which is in 2022, 50 million ringgit, and in 2024 at 200 million ringgit. And then beyond 2025 is when we will be looking into IPO. We do think our most possible exit would be an IPO. And that happens beyond 2025 when we hit the 2 billion ringgit a year mark in terms of revenue. So for every 5,000 ringgit that you invest, you would be at 91,000 ringgit, 91,500 ringgit 5 years later. So this is the trajectory that we have achieved in the past, and we are still projecting to hit in the next 5 years as well. Just to also give you a view of what will happen in the next 5 years. In 2021 to 2022, we will be focusing on FMCG alone, expanding within Malaysia for grocery stores and restaurants. So restaurants is a 3 times larger market than grocery in Malaysia. Then the next 2 years, we will basically start operations in three more countries, because this is the time that I'm aiming to raise that 50 million ringgit, which is the next round. And we would be expanding into 2 more verticals in Malaysia first, which is hardware and automotive. Why I talk about verticals here is because we are building an infrastructure ultimately with the technology, the warehousing, the logistics, and the financial services. So this will allow us to basically go into any vertical that is fast moving. And then in the next 2 years, we will expand that two categories in all the countries we are in, and we are targeting to be in 5 Southeast Asian countries. And 2025 onwards is when we will be looking at IPO for the major exit for all investors. So this is just the team. This is the last slide. So there's myself, there's Lakshman on the team as well. Lakshman is our COO, and he drives every business development and supply efforts within the company. So he leads large teams to achieve this objective. Numi was part of Nexia Ventures that invested in our accelerator and pre-seed round, ended up joining us as our CFO 2 years ago. And Dennis is our technology guy that leads the technology team that builds stuff that offline people will eventually start using online. So that's what his team specializes with. And we lead a team of 60 plus people right now in Sungai Buloh. So that's all. I'm looking forward to answering any questions you guys may have. Thank you very much.
Okay, that was a great presentation by Tinesh.
Thank you,
So
sir.
next up, we have the Q&A portion of the segment. Okay, at this point in time, I would like to inform the attendees that you can utilize the raise hand function on Zoom to ask your questions live. And I will then allow you to speak directly to Tinesh. Now, while waiting for some of the participants to ask live question, we'll go through some of the questions here already posted on the Q&A section on Zoom. Okay, Tinesh?
All right.
All right. So the first question we have posted here is from anonymous attendee. Are you constrained by the 5% gross margin, or are you able to create more?
Yeah, so our gross margins are increasing month over month. Right now, we are not very constrained. We are already at break even. When we started, of course, especially on the FMCG side, it was very small. The margins were 1% and 2%. Right now, we are closer to 4 or 5 towards that area. We are going to be able to increase it to about 8 to 9% by end of Q1 2021, which at that point is not a constraint anymore to us. So margins tend to increase as volumes increase. And now that we are already at that break-even point, it will not be a constraint, but it's about pushing it up faster moving forward. So at this point, not anymore.
Okay, that's great to know. Okay, our next question comes from Michael Lin. Now he's asking, how big is the 5% financial service component in Lapasar currently in terms of your total revenue?
How big is our financial services? Okay, so there's there are two categories, and there are different buyers and sellers. On the office supply side, our half of our gross profits monthly, 50% of our gross profits monthly comes from financing activities. So how we do that is we bring on board all these large guys, and all their merchants are coming on board as well, right? And usually these guys, these corporates are paying within 30 to 45 days. And so what we do is we pay these merchants within a week, and we charge them 2 to 3% for this early payment because we have the invoices. It's all our invoices, right? So 50% of our income is already from financial services today. Now on the FMCG side, where we are rolling out this particular mobile application, we have not rolled it out yet. We have secured the partner. We are rolling out offline first. For now, none of our revenues come, no financial service revenue is coming from this segment yet for the retailers, but we are expecting to start monetizing it as soon as 2 to 3 months from now. So on the office supply side, already 50% of our income comes from financial services.
Okay, that looks healthy currently, right?
Yeah.
Okay, so the next question. When was your last funding round? What was the valuation for that? And how do you justify the current valuation?
Right. So this is a journey of our valuation. So if you ask me about the last round was in June 2019. We raised 2 million ringgit from a Singaporean VC called Seed Plus. Our valuation was 16 million ringgit. This round, we are raising 10 mil at a 50 million pre, if we raise all 10 million, 60 million post money, right? And generally how marketplaces like ours are valued is one-time GMV or gross merchandise value or total transaction amount, one time of that, right? And if you look at and that's annualized. So our current run rate is 7 million ringgit a month, which means 84 million ringgit a year, right? And we cannot take one time. We are unable to take one time of that, particularly because our margins are still below 10%. So we took that into account, and you add on another 20-30% discount is where we ended up with 50 million ringgit pre-money valuation.
Okay, all right.
Yeah.
I think when it comes to investors, valuation is the tricky part that you have to have a
Yes.
well-crafted answer. But I think
Correct.
you're doing quite well there, right?
Yeah.
So our next question is, who's your closest competitor? What makes you better than them?
Right. I think in terms of the office supply space, our closest competitor would be Supply Card, if you have heard of them. That being said, Supply Card came into the game slightly later. They started off as an SME platform. In terms of market share of corporates in Malaysia, we're definitely the leaders in that space. In terms of any Malaysian B2B marketplace. And why we are better than them, than Supply Card per se, is I think it was just the first mover advantage. And what in this industry, once we have moved first and we have served so many corporates, the know-hows and the experience of executing for the next and the next, we become much faster. And another thing is we are heavily integrated into these corporates, which means the competitor that comes in it's very hard for anybody to sort of creep into the corporate space. Now, in terms of the FMCG space, a lot of people know Droppy, but Droppy actually has a different business model altogether. They are more of a SaaS player, so software as a service. So they're providing that software to distributors to manage their sub-sellers, resellers, their sub-distributors, so on. In terms of direct competitors to us on the ground would be Potboy. If you have heard of Potboy, they are quite large. If I'm not mistaken, they do anywhere between 50 to 60 million ringgit a year. But they are more consumer focused, but they have a small B2B arm as well right now. And in terms of why we are better holistically compared to a lot of our B2B marketplace peers, is because I take a very Alibaba and Amazon kind of approach in this space. To build a successful marketplace business, what we learned from them is there needs to be 4 pillars. And the pillars are basically technology, warehousing, logistics, and financial services. These are the 4 pillars that needs to be there. And in comparison to any one of our peers, we are in all 4, and we are ahead in all 4 as well. In terms of our numbers, in terms of our gross earnings per year, so on and so forth. So that I think is our ultimate competitive advantage right now.
Okay, I think to be fair to you guys, e-commerce and marketplaces are one of the most fastest growing segment out there. It's logical that you see a lot of competitors in the space, I believe, right?
Yes, exactly.
Okay, so our next question comes from Mr. Richard Wong. Now he's asking, would you ever do a SaaS model like Droppy?
No, we would not. Not now. Maybe in the next 24 months, yes, when we have that scale. But why we wouldn't do it is we believe our approach to building technology and digital solutions is we've got to get the fundamentals right. And nobody in the market today absolutely knows what is the pain point end to end in the supply chain, correct? Nobody can claim that because everybody's new in the space. So the approach we took is basically, let's get down to the ground. Let's visit the shops. Let's visit the distributors. Let's talk to them. And let's start supplying to them. Let's start taking charge of the supply chain, right? So from the point of movement of goods, delivering it to them, trying to get them online, trying to get them pay online, we are fixing the fundamentals. So for instance, if you go into a shop with bad prices, bad delivery, but sell them a digital solution, you are not going to create an impact in the market. So this is something that we learned very early on. So what we did is we went to the ground. We are fixing the supply chain. We are fixing the stock allocation issues. We are fixing the delivery issues. We are making sure the products are priced right, and then we are giving them our online ordering solution, and we are putting in lines of credits. Now, when that dependability grows, and in the next 24 months, 10,000 shops are using it, then we introduce SaaS solutions for the distributors to handle their sub-distributors right down to the retailers, or we could release POS systems for the retailers. I think when scale is achieved, real problems are solved, is when we want to look into SaaS ultimately.
Okay, all right, that makes sense, because I think you need to be strong at first in terms of what you are currently doing before moving into different areas of the opportunity, right?
Yes,
So
yes.
that kind of makes sense. Right. Now we've covered we've covered all of the questions currently, but I have a bonus question for you, right?
Yes.
With the infra that you are building currently, what's next after FMCG?
So, okay, now infrastructure is extremely important. Like I said just now, what Alibaba did well, or what Amazon did well, is building that infrastructure of warehousing, logistics, technology, and financial services. We are doing that. We will accelerate that with the current 10 million ringgit round. But what's beyond that is basically, I've indicated that here, right? Any industry that has a heavy retail footprint, for instance, automotive has a heavy retail footprint, a lot of mechanic shops around, restaurants, heavy retail footprint, hardware stores, also heavy retail footprint, or heavy reseller footprint, offline and online, like IT equipments, electronics. All of these verticals can be addressed using our infrastructure, because our infrastructure suits any sort of fast-moving verticals. And so that's the plan. And when you take into account hardware, automotive, fast-moving consumer electronics, and all these heavy retail footprint industries, it's easily a 2 to 300 billion ringgit market. So that's what's next for us, besides just getting out of the country. Malaysia itself is a huge market in that sense.
Okay, all right. So I don't see any more questions coming in. I think that's all the time anyways we have for Q&A. Now, for those participants who might still have questions, you can go on to the Q&A section of the business page, and then you can post a question there. And I believe Dinesh and his team will be on hand to answer all of your questions. Right? Okay, so before we go, any parting words you'd like to give, Dinesh, to convince the investors who are trying to decide whether to do the or not?
Yeah, sure. We are a company that has raised not much cash, about 2.5 million ringgit in total. We still have half the money. We have proven to become profitable twice already now, which means we do know how to build a sustainable company. In no way are we burning cash to achieve that fast growth that we have achieved. We are at 80 million ringgit run rate already per year. And we are extremely confident with another 10 million ringgit pumped, we are going to hit that 500 million ringgit a year run rate as well in the next 24 months. And I see an extremely clear path towards building a sustainable, profitable, and a public listed company beyond 2025. And I think we have an extremely clear path towards that when you look at our numbers. And we would be more than happy to share any sort of financial details that's needed to prove this point as well. And we are probably the largest marketplace in Malaysian marketplace. So that would be my parting words for anybody who would love to reach out to us for any other questions. My email address and my phone number is here as well. So I would be available anytime to answer any questions.
Okay. Personally, I like your sensible approach to pitching, Dinesh, right? And you do seem to have an attractive company on your hand currently. Okay, so I believe that is all from us, and I would like to thank everybody for spending their time today. I hope everyone will continue to have a nice day, and we hope to see you here again sometime soon. Now, good day and stay safe, everyone.
Have a nice day.